Dear learners, welcome back. In this video, we will be understanding two important doctrines of company law. The first one is the doctrine of ultra vires. In Latin, ultra means beyond and vires means power. Putting these two Latin words together, we get ultra vires, which means beyond power. So, any act which is performed by a company and which is beyond the scope of the Companies Act 2013 will be termed as ultra vires. This is because the company has gone beyond the rules laid by the Companies Act of 2013. For example, if a company appoints board of directors without following the formalities laid in the Companies Act, or a company pays dividend out of capital, then these acts will be ultra vires the Companies Act. In simple terms, these acts will be beyond the powers given by the Companies Act. There is one more aspect here. Memorandum and Articles of Association are two very important documents of a company, and they list the limits within which a company is permitted to perform or act. So, whenever any transaction or dealings or act of a company goes beyond the rules laid in Memorandum of Association or Article of Association, it is also termed as ultra vires. Ultra vires acts are null and void ab initio, which means they are void from the beginning. Ultra vire acts will create a personal liability on the directors of a company. So, in short, if a company does anything beyond the scope of the Companies Act or beyond its memorandum and articles of association, then the company is committing ultra vires. Let us look at the case of Ashbury Railway Carriage and Iron Company versus Ritchie in this context. Ashbury Railway Carriage and Iron Limited Company stated in its memorandum that the objectives of its business will be to make and sell or lend or hire railway carriages. It was also stated further that any activity done by the company beyond this objective needed a special resolution. Now, this company entered into an agreement with Ritchie and his brother to give a loan to them to build railway tracks. Later, the company repudiated the agreement, on which Ritchie sued the company and pleaded for ultra vires. The court decided the case in favor of the railway carriage company, stating that a company cannot go beyond its objectives as stated in the Memorandum of Association. The entire contract of lending money to Ritchie for building railway tracks was beyond the objectives of the company, and so from the beginning it was void. Coming to the second point, corporate veil and the doctrine of piercing or lifting the corporate veil. You already know that the company has a distinct legal entity and a company is different from its members. Due to this, there is a corporate veil between the company and its members, which is an imaginary barrier or a curtain which shields and separates the members from the company. The court can break through this corporate veil and apply the doctrine of lifting or piercing of a corporate veil in case the company is suspected of any fraudulent and dishonest activity. The various circumstances under which the corporate veil can be lifted fall into two categories: judicial provisions and statutory provisions. Let's look at the judicial provision for lifting the corporate veil. Courts can order lifting of corporate veil on the grounds of fraud or improper conduct by a company. There is this case of Jones versus Lipman. Here, Lipman entered into a contract to sell his land, but later he changed his mind. Now, Lipman knew that the court would order him specific performance to fulfill the contract of sale. So, he transferred his property to a newly formed company. This newly formed company was also his own company. He planned that if court orders him to continue the original sale, he will plead that he has already sold the property to another new company. Later, the judge lifted the corporate veil of this new company and found out that the actual member of this new company was Lipman, and the judge concluded that this new company was formed by Lipman to avoid the contract, and the judge ordered Lipman for specific performance. Second circumstance to pierce or lift the corporate veil includes the case of a company which may be considered as an enemy character, which means the individuals who control the company's operations are resident of an enemy country. To understand this better, let's look at the case of Daimler Company Limited versus Continental Tire and Rubber Company. In this case, an English company was incorporated in England for selling tires in England. These tires were made in Germany. In this company, all the shareholders except one were Germans residing in Germany. During the First World War, when England and Germany became alien enemies, this English company filed a suit for recovery of a trade debt. But the court decided that this company was an alien enemy because all the members of this company except one were Germans. Court said that payment of any debt to this company will be regarded as trading with the enemy, and so this company was not allowed to proceed with any action in England. Corporate veil can also be lifted or pierced if the sole purpose for which the company is formed is to evade taxes. Let's look at the case of Sir Dinshaw Manikji Petit, AIR 1927, Bombay. The person in this case was wealthy and he was earning a lot of income in the form of dividends and interests. So he set up 4 private companies and saw to it that all his income is divided among these 4 companies. Later, the 4 companies used to return him the money in the form of a pretended loan. By doing so, the person could pay lower taxes as his income got divided into 4 smaller parts. The court, however, lifted the corporate veil and found that all the 4 companies belonged to the same individual and ordered him to pay a higher tax slab. Moving further, if a company is formed in order to avoid welfare legislation to the employees, then the court orders piercing of the corporate veil. For example, a company is doing very well in terms of profit, and due to this, it should pay a bonus to its workers. But in order to avoid payment of bonus, this company creates another subsidiary company and transfers all its profit to the subsidiary company and shows low profit to the workers. The court can order to lift the corporate veil and find out the real members of the subsidiary company and can order to pay the bonus. Furthermore, if the conduct of the company is against public policy, the acts of a company are against justice and interest of revenue or against public interest, the corporate veil can be lifted. Now let us see the statutory provisions for piercing or lifting the corporate veil. Under the statutory provision, the corporate veil can be lifted when the number of members reduces below the minimum requirement, that is 2 for a private company and 7 for a public company. It is necessary to lift the corporate veil here because reduction in members will increase the liability of the remaining members, and any debt arising later will have to be borne by the remaining members. Next, according to section 542, if a company's business is carried out with the intention to defraud creditors or to conduct any fraudulent practices, the corporate veil is pierced. If a company fails to refund application money on shares, then also the court will order to lift the corporate veil. So this was all about the corporate veil, lifting the corporate veil, and doctrine of ultra vires. With this, we complete the video on module 1. Thank you for listening. Stay tuned for the next session.